And welcome to the Beyond the Dollar Signs podcast with your host, Mark Taylan. Mark, good to see you again.
Hi, Bill. It's good to see you as well.
I enjoy our visits. And this one I am looking forward to because, there's a saying, money is emotional. And I don't think a lot of people understand that's true. Money is emotional and it can get in the way of helping you have clarity in terms of your financial choices. And I know that that's what you want to talk about today. So we're going to sit back and listen to you guide us to maybe making financial decisions a little bit more clearly, if you will.
Yeah, it's a great, it's so important to understand the emotions that drive people's decisions when it comes to money. And I really think that comes down to their values and what's important to them. And oftentimes when we're meeting with clients, especially for the first time, we certainly can go into the kind of the numbers and the that side of the logical side very quickly. And it's easy to do that and go right into that mode. But I think I like to take a step back first and understand what the emotion is. What do they, what drives that decision? What's important to them? Because money, I think, is represents, comfort to some people. It brings up a lot of emotions, maybe from, things that have happened in the past.
Mm-hmm.
And so often I find that until you really understand what drives, what are the emotions behind money, what does it mean to you, then how can you really give advice, that's tailored to your clients, and really, have a really good understanding. So I want to talk about that today because I think it's so important. A lot of advisors just cram charts and numbers down people's throats, and I think they miss a big part of the process, the most important part of the process.
No, it's interesting because you're in a numbers business. So I think it's really easy to lean on those charts and lean on those numbers and everything else. So now I'm curious, how do you go about identifying those emotions and those biases and those things that are there that you want to deal with? How do you uncover that and how do you identify it?
Well, what I like to do in our meetings is I say, before we get into any of the numbers, I'd really like to step back and understand it. And usually if it's a couple, they both may have different emotions. They have different feelings. And so we're very cognizant of, we need to understand both. And sometimes couples realize together, like, I didn't realize you felt that way. But I think the first step is going back and understanding, how they accumulated the wealth they did. Where did this come from? Was it humble beginnings? A lot of times we run into clients that have amassed a very significant amount of net worth. And I said, well, tell me about the journey to get to this point. And a lot of times we find it's humble beginnings. I came from a poor family. We didn't have a lot. And so, and what you find is what drove those emotions drove how they invested and got to this point. Maybe they were very strong savers. Maybe they were very conservative about how they looked at things. And so the investments that they have make a lot of sense to me. The way they think about debt, because maybe things were very tight growing up, maybe they had big families. And so I always ask them, what does money mean to you? And what do you hope to achieve at this point from what you've accumulated? So I think it starts there.
It's interesting because I would imagine you get a lot of different kinds of answers. I laughed when you said husband and wife sometimes discover that they're not looking at money or they're not looking at assessing things in the same kind of way. And my marriage is very much that way. I'm very much the risk guy. I will embrace risk. I'll take risk on. I'm fine with risk. And my wife is like, no. So how do you, I'm not asking for financial counseling for me, okay, Mark, but how do you when you're talking and you've identified these things, how do you talk to a couple that maybe didn't realize they weren't quite on the same page? Maybe they're very different. And how do you
Yeah.
go about, sort of, developing some practical ways to deal with the differences because people are different. And how do you work with those?
Yeah, it's what we find often is there's this sometimes couples have an intuition like I'm more aggressive than he is,
Yeah.
or she's more
Oh
aggressive
yeah.
than he is,
Right.
right? And so oftentimes what helps with that is, we have a number of questions that we ask, a risk questionnaire if you'd like to go that route. And
Hmm.
we have them answer these questions independently of each other. And a lot of times, once they've answered maybe 10 to 15 different questions on how they feel about, risk in general. If I was certain to make 10%, and only lose, in the worst case, lose five, which would I choose? Right? Would I risk all of my money for the potential to double it with the threat of losing half of it? It's questions like that
Yeah.
can help drive figuring out like really what is their risk tolerance? How do they feel? And it was fascinating because I had this at a recent meeting.
Hmm.
Husband, wife came in. Certainly the husband was, identified that he felt like he was more aggressive than the wife was. And in based on conversation, you can kind of sense that.
Yeah.
But I had them both, we asked both of them the questions. They actually both did a questionnaire. It took a little bit of about 10 minutes. And it was fascinating because when I scored them, they came out with the same risk number,
Wow.
meaning that they didn't answer the questions the same way. Um, it was multiple choice, and each answer came with a certain number. But
Hmm.
at the end of the day, the risk number was the same. And so, what was fascinating about that is, realizing that hey, maybe we were on the same risk level, and then when we take that data, we're able to say, based on a risk level of moderate growth, let's say, or a risk score of
Right.
65, we'll call it that. This is how that translates to investments. And this is the kind of risk that I would typically put somebody in. And here's what that portfolio looks like. With the market drops
Yeah.
50%, your risk score says that your portfolio should be down about 35, or it should be right in line with what the market is, that you can handle that type of risk.
Mhm.
And I always we use a lot of different software to illustrate, and model market risk. When a client has let's say a $3 million portfolio and the market's down 10%, that's $300,000, right? That's big numbers, right? And so
Significant amount of money. Yes.
it is. And I show them that on the screen. I said, what, a risk level of this, it's not uncommon to be down 10 or 15%. So on a $3 million portfolio, you're down 300 to $450,000 at some point in the year. How
Yeah.
do you feel about that? And really what I'm looking for is the gauge of how they connect that number and the emotional response. Oh, I would be really upset. Would you sell? Would you would you hold on because you're a long-term investor? What would you
Yeah.
do? Because I really want to get the reaction. I want to see what the response is, because number one, the reason why most investors don't realize the average returns is because they get emotional. They sell at the wrong time, right? They always sell at the wrong time. And if they time it just perfect, I got out at just the right time, they don't know when to get back in. And a fascinating story. I met this client, and prior to the 2008 crash, he said, "Guess what? I timed it perfect. I felt like something was wrong. I cashed out my $1 million portfolio, right? And I've been sitting and I went to cash. Well, that's amazing. How did you have the insight?" And he just said it was based on a feeling. And I said, "That's great." And I said, "So," and this was 5 or 6 years later, right after that, I met him after that, and he said, and I said, "So what was your strategy to get back in?" He goes, "Oh, I'm still in cash." I
No.
never got back in to the portfolio, right? I never got invested in again. And so it's so difficult to make kind of a binary decision. I'm in, I'm out, right? I'm in, I'm out. So
Well,
it
yeah.
really doesn't translate well.
No, just as an aside here, yeah, as a business and financial news reporter, I've got many stories about people who think they're smart enough to time markets.
Hmm.
Oh, I know when to get out. I know when to get back in. I know when to get out. I know when to get back in. And I'm like, look, I will go introduce you to 50 different analysts and I will
Hmm.
give you 50 different answers to that question. So, so
Yeah.
Mark, when you're talking when you're talking with your clients and you've identified these risks, how, and you've created some self-awareness that couple that realized, oh, wait a minute, we're not that far apart at all. As a matter of fact,
Right.
what do you do? What do you do to help them build some, maybe some better, healthier habits and ways of looking at their money and their investments?
So our process is called Wealth Path, and so that whole process of discovery happens early on. And then the next step is assessing their assets and then running a financial plan to look at all the different risks, right, that come up in retirement. So
Yeah,
we look at things from a longer term perspective, right? Because investing is for the long term. It's not we're trying to achieve a goal in 1 to 3 years. That's different type of
yeah,
planning. And so I think the key thing is to get a client in the mindset of what are we investing for? What is the long-term goal we're trying to achieve? And that goes back to their values. What's important to them? What type of lifestyle do they want? And once we go through and we build a strategy for different scenarios, right? What if the market's really bad? What do we do? And so if they understand beforehand that, look, we have 2 or 3 different strategies that are going to be in place at all times to mitigate the risk of markets dropping. So that way your lifestyle continues, your income continues.
yeah,
What I mean by that is maybe there's a dividend strategy that pays that dividend regardless. Maybe we're using some kind of pension or annuity to provide guaranteed income. Or maybe we have a bucket of cash that we were just holding to cover expenses for 12 months in case the markets are down and we don't want to sell at an inappropriate time. So when they see that, look, we've got a multi-layered strategy to address the long term of what if and what if all of these things can happen in the future, and they see it from that perspective, I think their mind kind of opens up to say it really doesn't matter what my value is today or what the market's doing today or tomorrow or next month. These daily values, these headline news that they see on CNBC or whatever they're
yeah.
watching, it's meant to cause a reaction, an emotional response. And I think my job as an advisor is to say, let's look at the plan, let's make sure we're invested the right way, and that way we'll be more successful, and don't let emotions get in the way. And I find if you don't do the right thing and understand the client in the beginning, and you and put them in the wrong portfolio, meaning the wrong risk profile,
Hmm.
and that market drops, you're in for a tough road ahead, right?
Yeah.
Because I think my job is the hardest, and I always say this is if I have to talk you off a ledge. If
Mm.
and part of that is if I should have had you not had you exposed in that that way anyways,
Right.
that
Yeah.
that risk in the beginning. And so certainly there are events like the pandemic. We call it like a black swan event. We don't see that. I mean, we've never seen
Right.
that, anything like that. So those events are very unusual. But for the most part, if they have a longer term mindset, I think that's key.
Well, one of the ways money is emotional is that not only does it affect our approach to investments, not only does it affect our reaction to the markets, but people use money sometimes when they're feeling emotional, like meaning, we all know about the guy who goes on a diet and then he wakes up one morning and he goes, the heck with my diet. I'm going to eat M&Ms all day long. Right. Cause I'm just not
Yeah,
feeling well. I'm kind of down. I'm kind of depressed and M&Ms
yeah.
make me happy. The same kind of thing happens with spending because right.
Yeah, I'm glad you brought that up, and especially in retirement. there's that transition of having a paycheck to not having a paycheck,
Hmm.
and all of a sudden being on, I don't want to call it a budget, but a fixed, you're on a fixed income essentially, right? You've solved for whatever your assets can comfortably generate for you
Yep.
in income. So you're on a fixed income. Let's call it that,
That's
right?
what it is. Yeah.
Yeah. You think about it, you're retired. You've got a lot more time on your hands. What do we say? Every day is a Sunday. Every day is a weekend, right? So, and on the weekends, I know I'm looking forward to relaxing or doing something fun. So if every day's that, and you want a vacation and you want to do all these things, money plays a big part in that. So expenses can get out of the way also with emotions, right? Some people, spending or that instant gratification with buying things. And these days with Amazon and social media, it's so instantaneous, right? It's like I can push that button and instantly I've got new golf balls coming to my house I'm
Oh
excited
man.
about, or or I've got this new whatever you want to call it coming instantly, and that spending can really get out of control.
Hmm.
And I spend a lot of time when the client brings me their expenses because I have them go through this exercise. I said, "Okay, you've given me a list of your expenses here, but let me tell you, this is your baseline. You've got utilities, you've got food. Tell me a little bit about, oh, you've got 4 or 5 grandchildren. What about
Boom.
those birthday parties? Oh, you've got weddings. Let's talk a little bit about your house. How old is your house? You need a new roof." And
Yep.
so, and so the spending really, I like to be really detailed, not only on the what we need to have, but the discretionary spending. You like to
Yep.
vacation, okay? Expenses come up that you really don't factor in, and now you're way over budget, and your portfolio can't sustain that. And so, look, we're going to have a difficult conversation here pretty soon because the amount of money you're spending, whether it's because behavioral or we didn't plan right, we need to really take a look at this.
Yeah. So no, it is easy. I mean, the vulnerability around here is grandchildren, right? Because it's like, oh, yeah, we can buy this or we can buy that, and it's never anything that amounts to massive amounts of money. So it's like until you realize that like small things add up and become big things. And how do you? I mean, these are difficult. These are difficult issues for a couple to deal with. Where do you see the role of yourself and financial advisors like you in terms of I'm going to use the word intervene here. You can correct me if you want, but where do you see yourself in this process?
As I feel like I'm the gatekeeper to money
Mm,
oftentimes, right?
yeah,
I'm the gatekeeper because when they go off of plan and they're spending, we've got a set of distribution coming, but I get those calls. I need money, Mark. This came up, Mark. I need this, right? And all of a sudden, $50,000 went out. I'll give you an example. I had this happen this past year to a client. A lot of these things came up, and sometimes you can't avoid it, right? Big
right.
expenses come up, and they come up. But inevitably, what happened is we had planned for a certain amount of income. We certainly exceeded that because of the needs, the
Yep.
wants, and maybe the marginal things
Exactly.
they really didn't need, right? But
Of
guess
course.
what? Guess what, Bill? It pushed them to the next tax bracket because the distributions they took
Yeah, no.
from their retirement were too high. And inevitably they ended up paying 20,000 more in taxes. But guess who got that call, right? Needing a little bit more funds to pay the taxes, right? So it's my role as an advisor really to also monitor the cash flow, monitor the spend, because these additional draws from their accounts will have an impact on them, and I really want them to see that. And so I start the alarm starts going off and going, okay, we're gonna have this difficult conversation. And it's tough to say don't live life, but and to say you're compromising your future. We're going to have to make some difficult decisions. if you continue on this path. And that's my role as an advisor. And I hope other advisors monitor it as well. And that's why it's important to work with an advisor on an ongoing basis, because they're monitoring everything, from portfolio risk to cash flow. Yeah.
Yeah. It's got to be a tough role, though. It's got to be a tough thing to do.
It's not an easy conversation. I always look for ways to, how can I illustrate this the best? But at the end of the day, it's really is, if you continue on this path, you're going to run out of money. That's the bottom line. And so you need to make some difficult choices.
That'll get people's attention for sure.
What's that?
I said that will definitely get people's attentions for sure.
Yeah.
You're in danger of running out of money here.
Yeah, absolutely.
Unless you win the lottery, we could be in trouble.
And most people that win the lottery, they run out of money. It's so fascinating, right?
Well, no, that is fascinating. That is a whole nother podcast in and of itself, because people who do win lottery winnings, it's shocking how many are dead broke within 5 years of having won. It doesn't matter how much money they won. It's amazing to me. They clearly need to have financial advisors talking to them, Mark.
I agree.
So to that effect, of people who are listening to this podcast who are not clients of yours already, for people who don't know you, what is the best way for them to reach out and at least begin an initial conversation with you to see maybe if you're the financial advisor that they might want to sit down and form a relationship with to get their money emotion under control?
Yeah, the best way to reach us is by email or book an appointment on our calendar, right? We have a calendar schedule where you can consult with us. I love talking to people and hearing their situation and getting to know them. So just reach out, and I'd love to have a conversation about whatever's on your mind.
Fantastic. Now, Mark's information is in the show notes. So if you're at a place where you can take a look at those, or when you are, please do, and reach out to Mark. The other thing I would encourage you to do, and it's easy, this takes nothing, just hit the follow button there. Hit it. Subscribe. Become a subscriber to the podcast, because if you are a subscriber, you're automatically notified the next time Mark drops a new episode of this podcast, and you can listen to it. You won't miss one. Also, if you like the podcast, I'm going to ask you to tell people about it, please. Just as a favor, please. Let people know that you find it useful, you find it helpful, you find it interesting, because word of mouth promotion is the most valuable promotional tool there is, and we will thank you in advance for that. So until next time, I'm Bill Tucker. On behalf of Mark Taylan and everybody at 360 Advisors, thank you for taking the time to listen to the podcast today, and we'll catch you next time. Thank you for listening to Beyond the Dollar Signs Financial Clarity. Click the follow button to be notified when new episodes become available. Visit our website at advisors360pwm.com or give us a call at 408-778-8280. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Advisors 360. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions that you may have regarding your investment planning. ECA does not provide tax or legal advice. Guest opinions are their own and may not reflect those of ECA. The viewer is encouraged to seek their own individualized tax and legal advice from a qualified professional.